I'm going to be talking about wealth creation in the context of retirement planning and employee benefits today. So first of all, starting with wealth. What is the definition of wealth? Wealth is the accumulation of resources. So when we talk about a wealthy landowner, we mean someone who has acquired a lot of land or controls a lot of land. When we talk about a wealthy merchant, we're talking about someone who has many goods under his control or has accumulated many goods. When we have a large number of such wealthy people living in a country, then we have a wealthy country. Examples of which would be, say, the United Kingdom or the United States of America, or in the East we have Singapore and Australia. As far as measurement of wealth is concerned, it is usually measured by assets minus liabilities, which gives us the net worth value of someone. As far as the definition of income versus wealth is concerned, we have wealth taken as a stock. In other words, something which has been accumulated over time, whereas income can be considered to be a flow. It represents the increase in wealth, or if it's an expense, it's a decrease in wealth. So now, having considered wealth, we consider management of wealth. Wealth management is considered to be an advanced financial planning, form of advanced financial planning for high net worth individuals, and we've already defined net worth. We have various professionals coming into this field of wealth management. People who look after estate planning, carry out asset management, portfolio management, and also give taxation advice. So this particular field is very well populated with lawyers and chartered accountants, and in India we're now seeing the rise of the certified financial planner. So effectively, as I said, wealth management is can be a form of private banking, which is where several departments of a bank helps an individual to manage his financial affairs overall, not just investment of his financial assets, but perhaps wealth, of course, has to be created, and there are different methods of creating wealth. We could start with the simplest method, which would be through regular savings. So someone puts aside a small amount of money every week or every month, let's say in a bank account or in a post office account. Now gradually this is accumulated and builds up wealth for this particular individual. We also have someone who already has a lump sum, perhaps through inheritance or even through a lottery win. So we have someone who has already got a large amount of money and they want to improve on that, they want to grow it, therefore take advantage of the wealth creation methods and systems available in the market. Such investments or such plans can be long or short term, depending on the requirement of the individual. If you look at it from the retirement point of view, we have someone who wants to retire early perhaps, and therefore needs short-term or shorter-term investments, as opposed to someone who has a fairly long term to go towards retirement. Some people will create wealth through risky ventures, because they're the sort of people who are prepared to take risks and prepared to do ventures which will give them high profits at the expense of high risk. Also, we have some people who have preferences for what assets they want to grow, where they want to invest, and in fact sometimes create new asset streams. We have the example of art. Someone who knows about art and let's say for a purely pleasure point of view decides to have art collection in their home, but eventually, because there's a demand for it, it may become a source of wealth creation in terms of high prices which are paid for it in the market. So we have various methods of wealth creation. Now that we've created it, of course there is the danger of being eroded, and there are several factors which causes wealth erosion. The first amongst them is, of course, inflation. And inflation has been defined as the gradual reduction or erosion of wealth through price rises over time. Another factor you would look at is the tax burden. So someone has created a large amount of wealth, a large amount of capital, but when it comes to liquidate that wealth, when it comes to take the cash in the asset, if you like, there is a huge tax burden he has to suffer, and that obviously has an impact on the net value of his wealth. Another factor would be a drop in the investment return. So he was expecting his fund or his capital to grow at a certain level. It's not growing at that certain level, and perhaps as a result it's not keeping up with inflation. So perhaps he's going backwards in terms of growth. Next, we can consider personal circumstances. And suddenly he is faced with unemployment, and that would obviously have an impact on how much he can grow his wealth, or how fast he can grow his wealth. And in fact, sometimes he can go backwards because he may have to take money out of that capital he has grown to meet his other expenses. Finally, one of the important things to bear in mind is the overall economic situation of the country, where perhaps the country is going through a recessionary trend. So all the sectors are affected, all the medium of investment are affected, and there is a general. Having just touched on inflation earlier, it is a very important factor, and perhaps we should look at it a bit more closely. So let's look at that again. As I mentioned earlier, inflation is reduction in wealth through price rises over time. And inflation, the effect of inflation just cannot be overemphasized. We have in the future, for example, in Germany, had hyperinflation, which caused virtual worthlessness of currency. One time they were printing million mark denominations, which the next day were not worth anything. So hyperinflation is one extreme form of inflation. Another form of inflation which affects us all is, of course, the inflation of goods in terms of unavailability of goods. So where there are reduction in the availability of goods, that affects inflation as well. With regard to measure inflation, we have the wholesale prices index and we have the retail prices index. The wholesale prices index, of course, measures the difference in prices at the point of production, at the factory door, if you like. Whereas retail price index would measure the changes as it's distributed to the customers, the individual customers. As far as retirement planning is concerned, it affects retirement planning. Inflation affects retirement planning in two different ways. First of all, if you have set in mind a certain amount of fund which needs to be produced by the time you retire, let's say 20 years time, and if you don't take into account inflation, then it can cause difficulties. So let's say you have decided that a fund of 50 lakh is required at the point of retirement, but 50 lakh today may not be worth 50 lakh in 20 years time because of inflation. So that has to be built into the formula to look at how much fund you will eventually require. Another way in which retirement planning is affected is once someone is retired, they may very well retire on a fixed income. Of course, as prices continue to rise, it reduces the value of how much can be bought with that income, and therefore has a very strong influence on, or strong effect on an individual's standard of living after retirement. Inflation can also determine or direct whether a person wants to retire early or late. He may be planning to retire early so that he can enjoy a longer, secure retirement time, but because of inflation, he may have to grow or accumulate a higher amount of capital, and therefore he requires a longer period than normal than he expected. So we've covered the creation of wealth in the context of retirement planning, in that it is of course necessary to have to grow your funds, to grow your capital, so that you can meet your retirement requirements at the appropriate time. We looked at different ways of creating wealth through regular savings, through proper investment of lump sums, and also the erosion which wealth suffers through inflation, burden of tax, and so on. So we'll stop there for today. Thank you.